Hello everybody. So today's video is gonna sound like a warning or a reminder to those who already know, but in my comment section I get a lot of people bragging about owning 100 shares, 1,000 shares, 10,000 shares sometimes of these 2x leverage ETFs. And of course on this channel we are focused on long-term investing, i.e. more than a year, more than 2 years, more than 10 years ideally. And I want to talk about these single stock 2x ETFs because they are very, very tempting, especially to new investors, and they are marketed hard. If you are on X, for example, or even on YouTube and you have ads on YouTube, you will find ads for these ETFs all the time. There's new ones being popped up all the time. I'm just, putting an example of the direction, but this is not to pick on any of these ETFs. T-Rex is another big one, the T-Rex brand. There's multiple brands of ETFs like that, and in fact, they have multiple versions of the same 2x ETF on the same stock. And in my 15 years, I'm now reaching 15 years of investing, I have seen my fair share of these type of ETFs being promoted, oftentimes on growth ETFs, even more often on income ETF. They'll buy some revenue generating stocks, some income stocks, and then they'll leverage it 3x, and then they'll show a 30 or 40% dividend. And I can tell you that these instruments are short term because I have seen my fair share of these ETFs either entirely disappear, be liquidated down to zero, and this is a real thing. These ETFs go away. And I'm not like I said, I'm not saying any of these will. I'm just saying historically, I've seen so many of these ETFs go away. And of course, it is logical if a stock drops 50% and you have a 2x ETF, what is 50% times 2, right? Need I say more? No, I don't. I've seen my fair share of them liquidated. I'm not saying this is what's going to happen. What I'm saying is that over the long run, these do not work. Usually, there are some anomalies, and I'll acknowledge those, but over the long run, it's a tough sell. These are really designed for short-term hold. Think the day, and I know some people say multiple days, some people say a month, but to me, they were literally designed just for the day. And so I want to go through some popular stocks and show you what I mean. 2.5 years MSFU 2x Microsoft versus MSFT, right? The 2x Microsoft was 11.9%. The actual stock of Microsoft was 17.6% over 2.5 years. You've significantly underperformed holding that one over more than 2 years. And you'll see this is true for so many of them. I'm just showing 4. Google, look at Google. 2x Google, 2.5 years. This double 2x Google was launched in September 2022. Up until today, March 2025, 2.5 years, it performed 13%, 13.8%, while the actual stock performed 18%, the non-leverage, zero leverage stock. Look at Tesla. Tesla is even quote-unquote bloodier. If you look at Tesla, the TSLL, the 2x leverage ETF Tesla, returned an average of minus 16% over almost 2.5 years, while the stock Tesla returned an average of 38% over 2 years, or 15% average annual return each year over the past 2.2 years. So TSLL was a negative return, even though it's a 2x, while Tesla was a positive return. And this is because of volatility decay, bigger swings, bigger decay. I'll get to that in a second. MSTR, of course, a stock popular on the channel, a stock that I love very much, and I'm all about the common. I just speak of the common, but if you look at MSTU versus MSTR, so MSTU, of course, is one of the 2x ETFs on MSTR, you achieved 123% annual gain versus the common stock 169%. Where did the 50% difference between the two go? They went into some of them fees, most of them volatility decay. The more the asset is volatile, the less these work. And obviously, these ETFs tend to be, promoted pretty hard on volatile stocks and volatile assets. So there are some anomalies and outliers, and let me point them out. Typically, these ETFs are outliers when you look at them over the short term, say half a year. Look at Netflix, the 2x Netflix right now, right? It's outperforming the regular Netflix because we are about 5 months in. How confident, and it's 83% by the way for this one versus 52% annualized return. So the 2x is outperforming a little bit. It's not a 2x, but it's outperforming a little bit. Question is, given that you know that this is a 5-month-old ETF, how confident are you that this outperformance will continue? How confident are you that the Netflix 2x ETF will not turn out just like those 4 ETFs I just showed you that are, fairly older, right? Same is true, for example, for NVIDIA. NVIDIA still works after 26 months. And my guess is NVIDIA is still working because we had relentless upside of NVIDIA. NVIDIA was just up only. That's kind of my guess as to why this is working for NVIDIA 2X versus NVIDIA regular. But first of all, the outperformance is not nearly a 2X. The outperformance is 172% average annual return versus 121%. Really impressive. Don't get me wrong. The question again is the same. How confident are you that this will continue, especially with the recent volatility swings that there's been with DeepSeek, that there's been with the tariff fears? And if you look at an equally volatile stock to NVIDIA, which would be Palantir, if you look at Palantir, you can see it doesn't really work for Palantir right here. Okay, it's not a long enough period, but still it doesn't work. Palantir returned 22% over a 3-month period. Palantir 2X returned minus 37%. These instruments were never designed to be held over the long run. They are daily instruments. They are designed for daily traders. I know many people argue 30 to 40 days hold period. Reasonable people argue that. It's definitely not my style. I know people sometimes take them for swing trades, but it's definitely not my style and not the style of investing of this channel. So that way, you know that. I suggest you have a conversation with the AI of your choice to just look at how these ETFs work. And if you have a conversation with the AI of your choice, you will see the bigger the swings, the bigger the decay, the bigger volatility decay. This is Grok's demonstration as to how decay works. Feel free to read it. And this is why, for example, this type of ETF has been slaughtered on a stock like Tesla, for example, entirely. When you have a swing of 50% down in a matter of weeks, it just does not work. And I am not talking about the index ETFs, because whenever you start talking about the index ETFs, people will be quick to point out about the TQQQ anomaly. And I know my words. I'm calling TQQQ an anomaly. Let's talk about TQQQ really briefly, because I know this will come up in the comment section. So TQQQ is 3x QQQ. Actually, over the long run, over 15 years, it's more like 2.1x long-term QQQ. That's point number one. It works. Why? Because relative to, say, a Palantir or a Tesla, the Nasdaq has lower volatility swings. The volatility of the Nasdaq has also not been as strong as it has been in the past. That's point number one. But the biggest reason, in my view, as to why this works on the Nasdaq is because of the circuit breakers, the market circuit breakers, which, are a form of control. It's not money printing, but the underlying mechanism for money printing have the same underlying mechanism behind, say, saving the market, right? You want to save the system by printing more money. You want to save the market by having circuit breakers. And if you have, again, conversation with your favorite AI on this, right? They were triggered. These circuit breakers have been triggered multiple times. And for example, for the QQQ was saved multiple times during the events of 2020 to save the Nasdaq. And you have circuit breakers at 7%, right? And so when this week, this fell 5%, when the Nasdaq 5%, you gotta wonder what would have happened had we had a 7% drop. We would have likely had a circuit breaker. I would argue without the circuit breakers, TQQQ wouldn't work, but the circuit breakers are there to save the ETF. It is still a daily instrument, was still designed as a daily instrument. I would also argue that you can replicate pretty darn close performance, if not better, if someone is comfortable with using 50% margin and buying the stock of margin. Of course, yet another thing that I don't do on this channel, the max margin that I consider okay to be ready whenever we have big swings down. The max is 10% that I consider okay, but I'm fully aware that some people are perfectly fine with margin, and if you are, you could replicate that really, really quickly without the risk of that anomaly stopping to work, because that anomaly could stop to work one day. Although it's growing less and less likely that that anomaly will stop to work, because we're in year 15 now, so it's less and less likely, and that's why many people, smart people, decide to have it in retirement accounts, because retirement accounts, of course, don't have margin, and you can't replicate that with margin in retirement accounts since you don't have access to it. But this is an anomaly. You got to be fully aware. And my stance on these ETFs, and I hope I was able, these ETFs, all of them, this is my stance, and I hope I was able to be clear with you. My stance on this stuff is that it doesn't work. They don't work over the longer, and they're really designed for the short term, namely daily. So this was not investment advice, of course. You do whatever you want. This was not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe. Follow me on Patreon. Follow me on X. Thank you for watching, and have a wonderful, wonderful day.